welcome to this very special broadcast. And I call it a very special broadcast because it's kind of the need of the hour. The RBI has stepped in to bail out the mutual fund industry, at least a part of the industry dealing with relatively low liquidity assets, if you will. The mutual fund industry, though, maintains that it would be an exaggeration to paint the entire industry with the same brush, because they say that most mutual funds are doing reasonably okay, have adequate precautions in place, and therefore will not be subject to the same kind of fate, if you will, that Franklin Templeton was subjected to, so to say. Joining us now to talk about the industry view and ICICI Prudential as well, because there are a lot of queries around that as well, is Nimesh Shah, the MD and CEO of ICICI Prudential AMC. Mr. Shah, good having you. Thanks for joining in. Can you tell us your reactions to what's happened at Franklin's side, and then the regulators' move that came in yesterday, the impact of that?
Yeah, I think the regulators' move was well timed. It could have been earlier, but it's good that it came. That if the mutual fund industry needed liquidity because of the Franklin's move, see, Franklin had distributed mutual funds across the country, and most of the mutual funds of Franklin with the individuals in the country. Right. So when they suddenly saw that their money is not available immediately, not that they wanted money immediately, but they suddenly saw that if they want the money is not available. So I think people have had a scare. So government can, by government intervention, has soothed the nerves considerably. It was quite positive the way government said that the total category of credit risk fund is around 45,000 crores. Out of the 22 lakhs or 23 lakh crores that the mutual fund industry has, 13 lakh crores or 12 lakh crores will be on the debt side. And out of that money, around 45,000 crores is what is in the credit risk side. Right? So that's the size of the industry, size of the credit risk funds vis-a-vis the entire industry. Entire industry, if you look at our example, that you can extrapolate to the industry also, 98% of our funds, whatever we have invested, is in AA minus and above category, right? So that's the kind of quality that the industry has. The basic thing is that as long as you have given money in the right way and you expect that money to come back also in the right way, which has been the track record. If you see ICICI Prudential, last 3 years, there has not been a single delay in any of our money coming back, right? Last 1.5 years, so many accidents have happened in the bond markets, but not a single bond which went into default zone was owned by ICICI Prudential. So with that kind of background, your quality, if it is okay, you can have mark-to-market issues up and down, but if your quality of your giving money is okay, then you will be able to get liquidity against that. That's what the RBI circular has said, that banks can take money from RBI for a special line to be given to mutual funds. It can be by way of borrowing or it can be by way of buying of bond. Both is possible.
No, Mr. Shah, there are two counters that I have, and I would love your views before, and I would want to then talk about ICICI Prudential as well individually. But first, two counters, or not counter really, but a cross question. One, if I look at the Franklin papers, and please correct me if I'm wrong, but the 6 funds, right? The papers were spread across low duration, ultra short term, taking exposure to low rated papers as well. Now, that would mean that these papers were not present only in credit risk funds, but some of the others too. So how is an individual investor going to be able to ascertain that out of the plethora of mutual fund houses and the quantum of schemes that are available, which scheme would have some of these papers which would be not necessarily only having liquidity risk, but at times even credit risk? It's a big question.
So there are two issues you mentioned in any fund, whether credit risk or liquidity risk. In every fund, you specifically mention, if you see any of the fact sheets, it's clearly mentioned how much would be a AAA in that, how much would be AA, how much would be single A. So there are two things in a fund. Either you make money out of duration or you make money out of credit. So what kind of credit risk the fund takes is very clearly defined. There is a scheme information document which is filed with SEBI that clearly states what kind of paper can go into it. So that is one element. But the main important for a retail investor, the main important is while track record of that particular AMC in managing money, right? So it is very important to say whether in the past, last 1.5 years, one very basic indicator is last 1.5 years, As Warren Buffett has said, that you realize who's swimming naked only when the tide is down. So last 1.5 years, the tide has been down. How many mutual funds had a delay or a default in that? How many of your papers of that particular mutual fund went into delay or default? Right, that itself is an indicator. So when whether it is the industry, I won't talk about any specific fund house, right? Or neither do I want to comment on Templeton, because Templeton itself is doing fairly bit of communication. So I don't want to comment on what Templeton did, but everybody knew the quality of the portfolio, because the quality of the portfolio will come regularly. Every month the quality of the portfolio is out. So the quality of the portfolio everybody knew, and people knew the past experience of the last 1.5 years experience also is known to people. So when I mentioned that for ICICI Prudential, I can talk only about ICICI Prudential in these sensitive times. I won't like to talk about anybody else, right? So Templeton, one has to take the judgment on that. But ICICI Prudential, I can say that last 1.5 years, when the chips were really down and a lot of companies went into default zone, ICICI Prudential didn't have any. So the retail investor could have seen that there is no track record of any of the exposures going into default. That's all.
Got it. No. I by no means was trying to ask you to comment on Franklin, but I was just wondering that if one AMC, any one AMC, has taken exposure in not just credit risk funds but low duration and ultra short term funds as well, then maybe this is happening across some of the other houses too. And which is why my question. I'm not asking you to comment on Franklin.
Every scheme has got a mandate, and every scheme is run as per that mandate. That mandate very clearly says what percentage of funds can be put in, what percentage of credit ratings will be there in every category. Right? So it very clearly says the fund put so much into AAA, so much into AA, so much into single A. It clearly says. So all the funds will say that clearly.
May I ask you, Mr. Shah, may I ask you that in your schemes, in your low duration or ultra short term, etc., what is the mandate that you have laid out, and would you believe that that's a bit of a safe benchmark for people to follow, that investors before putting in money in a debt fund of any sort should look at that mandate and maybe weigh it against what's the quantum of A, AA minus, AA plus, AAA, etc.?
So that's what a retail investor can see. But there is a huge variety in AA and AA plus. That's not the only benchmark that one should see. Like when we also give money to people, do we only notice, yeah, this is the credit rating, but the assessment has to be our own, right? If I'm giving money, I have to do a thorough assessment. The rating agency would have given the rating. For us, that is only an indicator. So while ratings are a very important thing, ratings and track record of the AMC are the two things from which you will know the quality of the product.
Okay.
There can be variety of WAs also. That's what I'm trying to say.
Got it. Okay, fair call. The other question that I have, Mr. Shah, before I get to ICICI Prudential as well, and I also want to understand from you how would this work, this on money that RBI has given out. But I just wonder, there are a couple of people who put this out on Twitter to me, and I would ask you, because I mean, while I know the answer, so to say, but I would want you to tell me that for years, the norm has been that mutual funds give better returns than fixed deposits and are as liquid as fixed deposits, if not more for that matter. Does this issue, or maybe an issue that happened 2 years earlier, wherein there was some bit of side pocketing and some bit of stoppage, etc., put that into question mark, that it's not necessarily on tap? There might be times when money is put in credit risk funds or maybe some of the other funds might not be available necessarily on tap. How would the industry, or how would you counter that for ICICI Prudential?
For ICICI Prudential, I would say look at the track record. Forget my putting up, nobody puts a fees as it is put right now. But forget me doing about it, whether ICICI Prudential does or not. We have not had a single day's delay from any of our investors till date. 23 years we are into debt funds. We manage around 1,80,000 crores of debt funds. But in 23 years, I have not had a single day's delay that where my investors are telling me that we cannot pay you, or they have demonstrated that they have not paid. Every money has come back on due date. So that is one on the track record. Second thing, in the last 1.5 years, there has not been a single case where it has gone down to D. So those two are such important criteria that I'll be able to, that is my, and we have done a lot of hard work in convincing the retail that mutual fund is a very good space. It should also have equity. It should also have debt. It will take confidence to be rebuilt on this. We have worked hard a lot across the country explaining people what debt schemes are, and we will be continuously doing that because we believe that is one of the best asset class today to invest in a deflationary environment as we are in now. The times that we are seeing now, the volatility in equity normally is much more than the volatility in debt. Right, 42,000 index has become 32,000. People would have lost serious money. Debt people was the low risk money, so the volatility in debt. So look at my funds in the past. Look at our 5-year performance. Look at our 3-year performance. Look at our 1-year performance. The investor has whatever criteria that you laid down. I think our funds, if you put the tick mark, they put to all the tick mark that you had said. They will come down to saying that yes, in whatever benchmarks you had, I think our funds have fulfilled that.
No, I also think that at times debt funds or mutual funds, when they underperform a little bit, become the favorite whipping boy. And I think debt funds might be going through that right now, but it may not be entirely in that fashion. So, Mr. Shah, I have a small follow-up. You would say that it'd be wrong to paint. I mean, there might be instances wherein some debt funds might have an on-demand immediate liquidity redemption issues that may come up from time to time, but that would be a very small proportion, right? And part two of my question, therefore, does the RBI move attempt to stem that?
So RBI move is a fantastic move where if a mutual fund requires liquidity, a bank can provide that. It can be the bank can buy the assets or bank can also give a loan to the mutual fund. And bank will get money, which if they buy the instrument, they don't have to put it for mark to market. It can be held to maturity. So it's a very fantastic move that RBI has done, which will give a lot of liquidity in the system for the mutual funds to, if a mutual fund requires that bonds to be sold, it can sell to the bank.
Okay, Mr. Shah, one final question really from my end. Would you reckon that people should also, when they're looking at the current episode or any of the past episodes, try and understand whether this has happened due to liquidity risk or due to credit risk, and that might also give some answers to people before trying to either write off a fund house, an asset category, or an industry at large?
It is very important where you have given the money. I feel if the credit quality is right, this government is behind us to ensure that liquidity is there. I repeat my statement, if the credit quality is right, if you have given money to people who are going to pay you back, then this government will completely back everybody if your instrument is good, you will get liquidity against that. They have said instruments you can repo the instrument also. This has never happened in the history of this country, where we have got a repo facility also that I can give the bond to a bank and the bank will give you money against that. So three kinds of liquidity have been made possible. So quality and liquidity are the two issues. We are fully confident about our funds. If you see the fact sheet and all, one of the biggest investors in this particular fund is ICICI Prudential AMC itself. ICICI Prudential AMC has got 340 crores in its credit risk fund, which is almost 30% of ICICI Prudential AMC's net worth. And the employees of the AMC, we give that declaration in January 31st, we give a declaration to that, which is a public document. That on January 31st, the employees of ICICI Prudential had 42 crores in credit risk fund. So we are quite confident about our fund and our own investment is over there. That's what I will want to leave. And don't generalize. If something has happened to the one mutual fund, one should go into the issues of it, why it happened, what happened. Please go into the issues of it. But we should not generalize. That's why, and liquidity is available. So quality of credit is good and liquidity is available, then there should not be any issue.
Okay, Mr. Shah, we wish you all the best. Thanks so much for taking the time out and speaking to us today and giving us your thoughts.
Thank you. Thank you.
And viewers, thanks for tuning in to this broadcast. Remember, on the Mutual Fund Show on Wednesday, that is tomorrow, we'll get into experts to try and tell you how to create or how to have the right guidelines in place for approaching an investment in the debt funds. It's not a bad category. There are certain accidents that have happened, but these may happen anywhere. Keep that at the back of your mind. Thanks so much for tuning in.